Hello, it's Sam Francis here from Keep Trust Planning, and this is our very first case study. And we're going to be looking at the case of how can someone leave their £1.8 million fish and chip fortune to their loved ones and not the tax man. It's the story actually of David from Bournemouth. And David has done very well. He's built up a fish and chip emporium. He's got lots of restaurants and they're valued at a total of £1.8 million. So he wants to sell it. He sold his businesses and now he doesn't want to pay too much tax. It's a common feeling amongst our clients, certainly, and most business owners, I would say. He's paid tax all his life and he also wants to look after his loved ones and also enjoy his retirement, go on holiday and go on a few cruises, that sort of thing. And nothing at all wrong with that. So he has to be careful. What's he going to do with this £1.8 million windfall that he has for all his hard work? So he's worried about inheritance tax, as indeed he should be. He has, in fact, an allowance of £500,000 in total. That includes his £325,000 allowance for himself, plus an extra £175,000, which we know, which is known as the residential nil rate band. But that's really his allowance to pass his home, his main property, to his children eventually. So that's not going to help him with this £1.8 million fortune that he now has. So everything above that is going to be taxed, unfortunately, at 40%. So we don't want David to pass away now, because if he does, that fortune is going to be taxed at a whopping great 40%. So what should he do? Should he gift his money to the children? Should he take that money and gift it equally to the children, or not? Well, let's just look at the pros and cons of doing that. So first of all, if he gifts it to the children, it will be outside of his estate after 7 years. This is known as a potentially exempt transfer, and provided he actually gives the money away and he doesn't take any benefit from it, then yeah, sure, it's going to be outside of his estate after 7 years. But the problem with that is, as we're going to see, is it's tax efficient for him, but sadly it's not tax efficient for the children, because if his children have any money of their own, it's going to add to their estate and cause problems for them and the tax man later on. So he could set up a trust or a number of trusts while he is still alive. Is that a possibility? Well, my company's called Keep Trust Planning. We're a big believer in trust, and yes, it could well be a possibility. So he could retain control of the trust as a trustee, and he could start to put money into that trust. He could put up to £325,000 initially, and he could add to that over time. And the benefit of doing it that way is it's going to be outside of his estate after 7 years, but it's also going to be outside of his children's estate too. So it's a better way of doing things, we would say, potentially. Now, it is important whenever we talk about trusts that we take proper advice. We need to look at things like capital gains tax and other issues. But trust planning really can be used to alleviate inheritance tax. And we would urge you to take that advice and get some proper advice before you undertake any kind of planning of this nature. Anyway, that's this case study. It's just been a few minutes long. I really hope you enjoyed it. If you did, please subscribe to the channel and share the video. It would be absolutely fantastic. Anyway, that's me, Sam Francis from Keep Trust Planning. Thank you very much.